I'm going to tell you the undervalued FTSE 100 stock that I'm buying in August 2020 and adding to my portfolio. And all I ask in return is that you drop me one of these for the YouTube algorithm. Disclaimer, I'm not a financial advisor, and if you seek financial advice, please seek a licensed professional. I've really come to admire the resilient business model that this company has. And whilst there's certainly some risks priced into the share price currently, it really does seem to be undervalued. This company is effectively able to purchase various different machinery, products and equipment with their capital generated from their business and then lease this out to other companies such as construction firms, farmers, and then take a profit whilst they are paying down the lease. What makes this even better is that leaseholds usually have a contract that lasts from short to medium and even long term. So companies that have bought into these leaseholds are leasing a tractor, and this might be a 5-year period, effectively meaning that despite the pandemic, that this company will still be getting paid an income. This stock is in the industrial sector and is actually an excellent hold for diversification, as it offers the benefit of holding the industrial stocks, but also has less risk in this sector, as they are way less affected by lockdowns or the pausing of factory production or even construction sites. Since they hold a large range of equipment in which they rent, they're effectively diversified across all of the different industrial sectors. And this effectively means that they are much more diversified, giving them less of a problem if one certain industry shuts down. For example, for perhaps construction sites were shut down, in which case this company would still be leasing tractors to farmers, in which there's more social distance. On a farm, there's more space, and therefore they're still getting diversified income streams even if one has been stopped. And 40% of you watching this video right now aren't subscribed, so please consider subscribing, as it is free and doesn't cost a penny. Thank you. Currently, the stock is trading at a price to earnings ratio of 15.38 times, and this is less than the market of 15.6 times, and even the industry of 16.1 times, suggesting that investor sentiment is actually quite low, and that the investors believe that this company will actually underperform the general market, which to me seems a bit ridiculous, as in January 2018, this stock was trading at a price to earnings ratio of 21.6 times. However, this indicator can be exploited, and perhaps their earnings aren't doing that well and it's less consistent. Well, when actually looking at the historical earnings growth of this company over the last 5 years, they've managed to average a historical rate of 20.2% average earnings growth, which is excellent growth, and effectively means that with companies that are able to grow this much, they are usually priced higher of a premium, as they're expected to grow at much higher rates than the other companies in the industry, as they're able to easily keep growing by 20-30% year on year. However, I'm going to assume that the earnings growth has perhaps slowed down, and actually this is the case. In the last year, they've had a negative earnings growth of minus 7.2%, which is actually in line with their industry of 7.2%. And so I'm going to say that the pandemic has certainly negatively impacted their earnings. Whilst not by a lot, this obviously means that investor sentiment has been lowered, as it is a less resilient business than that of other companies in the market currently that have managed to continue growing their earnings. But does this undervalued stock still have growth potential in the future? Well, when looking at the company's ability to generate returns on shareholder equity, this company has actually managed to generate a return of 24.8%, beating the industry of 19.4%. Although this metric can be skewed by debt. So to avoid this, I'm going to look at the returns they're able to generate on their assets, and in which they are able to generate a return on assets of 9.3%, once again outperforming the industry of 7.8%. And if we assume some of these returns are reflected in the share price and therefore the growth of your capital, then it's fair to assume that this company will grow by at least a consistent and strong amount each year. However, they could have high debt in order to generate these returns. But when looking at their financial position, they are actually in a strong position. Whilst their short-term assets don't outweigh their long-term liabilities, they certainly outweigh their short-term liabilities, and they certainly have enough cash flow to be able to reduce this debt, which does present some risk, as if they are unable to pay down their debt using their operating cash flow, or just simply not able to generate enough revenue in order to pay it down, that this effectively means that this stock could be priced in lower and therefore more risky, especially with the pandemic. And currently this stock has a debt to equity ratio of 151.1%, which could be ringing some alarm bells, but over the last 5 years they had decreased it. Whilst it only looks like 1%, This is because for whatever reason they had taken up more debt in 2018, which had gone from around 105 debt to equity ratio to around 150 that we have today. Whilst they're actually easily able to cover their debt in an unrealistic situation by using all of their operating cash flow, which would be 22% per year, they still have a very weak cash position. Whilst more than historical averages, sitting at 241 million, this is likely just due to the pandemic and the uncertainty around it, and therefore they built their cash reserve up. But when compared to their overall debt of 4.4 billion, 240 million does look alarming. However, I'm going to assume that on the shareholders' reports that this is different, and in fact the debt that is here of 4.4 billion isn't actually as bad as it seems, but I don't have the time to look into this, and so if you know this information, please leave a comment down below. But I suspect their debt isn't as bad as it seems. But because of this, does this mean they're unable to support dividend payments or growth? Not only are they able to support a dividend payment currently yielding 1.63% and typically paid in February and September each year, but they are also able to grow it year on year due to their fantastic payout ratio of 25%. Historically though, they have managed to do much more than that, and they again have a fantastic dividend history in which in the last 10 years they've managed to grow their dividend by a compound annual growth rate of 30.22%. And this is during times like the Great Financial Recession, and they were still paying a reliable and growing their dividend at a good, strong rate. And this actually is the highest 10-year growth rate that I have seen and looked at in the Ftse 100 and nearly the Ftse 250. However, this is actually beaten by Carnival Cruises, although that wasn't really that great of dividend growth. It was just suddenly bursting the dividend up every 4 or 5 years. So more consistent dividend income, definitely this one. However, with such high growth potential and also dividend potential, there are some risks present. Firstly, the pandemic has definitely led to a lot of uncertainty around this stock, and effectively, if we go into a second wave and there's subsequently another lockdown, this stock will struggle, especially with their high exposure to the United States. This would effectively mean that they would see a lot of their income streams reduced. However, don't forget they are well diversified and therefore will still be getting money, but it would definitely force the company to potentially raise more capital, which could be a shareholder dilution or selling off some of their assets. And in fact, they've been very safe with their dividend growth in the last year, which they've only grown it by 1.62%, but it is better than a dividend cut or a suspension. This also means that the stock has a higher than the market average volatility of 1.33, effectively meaning that if the market drops, the stock is going to drop by 1.33 times more. And same if the market rises. So in order to really get the best returns out of this stock, you need to hold it throughout times of volatility, but it's a great opportunity for cost averaging. This stock is called Ashted Group, and if you'd have held this stock in the last 5 years, you would have seen returns with dividends reinvested of 178.9%, outperforming the industry of 53% and even the market of 12.5%. But that doesn't stop there. This stock in the last decade, from 2009 to 2019, managed to generate an annual average return of 43%. And you know that? It actually outperforms that of Amazon. Mic dropped. Oh. And if you're interested in my dividend stock to buy in August 2020, then click the card at the top right of the video. Thank you for watching. I'm Osborne Foreman. See you Sunday at 9 AM.